Welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you, as always, for joining us for the Market Carver, where we're going to go over some of the topics we discussed in our allocation meeting, which takes place on Monday afternoon. So we've got a pretty brief and light one for you. We're going to talk about the first quarter GDP number. So kind of give you a brief overview of the economy and some thoughts there, and then Andrew's going to take a look at what we've really seen with these rapid market movements. So let's go into the GDP. So gross domestic product, a widely watched economic report. It's really the broadest, but it's also one of the most backward looking, because here we are in early May and we're talking about what happened in January, February, and March. But this one was at least a headline getter because it was a negative. And traditionally, once you have two consecutive declines in GDP by quarters, that denotes a recession. So that's not all there is to a formal definition, but that's pretty much what it takes. But really one of the key points here is that we are for sure, the only thing we can be sure of is that we're going through a very noisy economic data time, and that is to put it lightly. And we really wouldn't make too much about the GDP being negative in the first quarter. And here's why. As you can see, we break down the GDP by several different components. You've got personal consumption. That by far is the biggest category. Government spending, private investment, inventories, and then net exports. So just by the virtue of how we calculate the GDP, we really take a final sales, a final consumption number. Net exports is key there, because some of those products were imported, and then some of what we produce exports. And so there's a netting out there, and net exports is usually a drag on that because we import more than we export. Certainly a focus of the tariff actions there. And as you could see, we saw a steep, dramatic decline in net exports. And a lot of that has to do with companies trying to get ahead of tariffs and really importing a lot of products in that first quarter. And that acts in the GDP equation as a steeply contracting negative. What we would really point you to are the two staples, two of the key components there: the personal consumption and the private investment, still enough to add about 2.5%. So we still have, in our view, at least a positive economy in the first quarter. It is undoubtedly weakening. It's going to take some time to shake out to see if that weakening just turns into a low growth, or if we do ultimately go a recession. But we really want to put that first quarter behind us. And even in a normal environment, we don't pay too much attention to GDP, again, because it's just so backward looking. But with the economy update there, I want to pass the baton over to Andrew to give you something more relevant to today's market and looking at the moves that we've seen.
All right, thank you, Adam. So we've really been seeing a pretty quick market. This is something pretty typical for when we start seeing stocks become a little bit more volatile. We start to see the trend go negative, as we've had for the bulk of this year. We start to see really big up days and down days, and investors are acting more on emotion than they are on fact and data. And with that, we see these big swings. In fact, we just registered where we saw the market decline 10% in 9 days. And then a little bit later, we immediately saw the market advance in 9 days, 10%. And so it's very unique to see the market move 10% in such a short period of time in both directions. And so, like with all types of market facts, we say that's really interesting. So what? So we start looking at the data, and we want to go back in time and see, has this been something that's happened before, and what type of markets does that occur in? And so that's what the chart I brought for this week's Market Carver shows, and one of the ones we discussed in our allocation meeting with our advisors. As we can see here on the bottom panel, we have what the market does every 9 days. We can see here recently on the far right side, we saw that drop of 10%, and then we saw a rise of 10%. And again, we haven't really seen this happen very often. We saw it occur during the COVID crash back in 2020, when we saw the market was in almost a waterfall, like free fall. The Fed stepped in and market shot right immediately higher. But besides that, we'd really have to go back to two very major market events: the tech wreck during the 2000s and the great financial crisis in 08 and 09. And during those times, we did see this level of volatility. In the tech wreck, it was, as we started seeing, it was a prolonged multi-year decline, and we'd see these big giant counter trends higher And those types of markets is where we'd see these big explosive moves of 10% higher in just a matter of less than 2 weeks. And then during the financial crisis, when we were seeing lots of headlines, what are banks doing? What's going on with the mortgage market? If you're in the market around that time, you probably remember it pretty well. I know I do. And it was a time where we saw a lot of volatility as well. We'd see the market shoot up higher on an announcement, maybe by the Fed stepping in, then it would drop, and it was a lot of volatility. And so during that time was another period where we saw this type of big move down followed by a big move up. The takeaway we get from this wasn't significant, or it doesn't imply a major market directional change. It wasn't something that we only saw at market lows, or it wasn't something that we only saw before a steep decline. It was just a characteristic of a downtrend for the equity market. Those are the types of those are the periods where we see this type of big move up and down. And right now we're in a downtrend within the equity market. We're seeing a rally. We're encouraged by it. We're happy. We hope it can continue, but we continue to be very mindful of the data and recognize that the longer term trend actually is less bullish, and we're still below key levels that we want to see from the price action. We still want to start seeing companies reporting good growth numbers, and on we go. But this type of volatility, the main takeaway there is this is pretty normal for a downtrending market. And it could suggest, maybe in like it did in 2020, that we could start getting the move to move higher, but we really are going to be cognizant of the data, not worrying about the headlines or tweets or anything like that, really focused on the hard facts of this market to drive our decision making.
Yep, Andrew, absolutely. And to that point, we don't always give you the chart, but we just want to keep you updated of the status. So, with that downdraft and with the updraft, our risk barometer, one of our primary risk management tools, has remained on defense. So many of you look to that for any key changes. So we've not seen those flip over to this point that would point us back to the other way. And Andrew, your caller around that certainly helps understand maybe why. So thank you to all of you for giving us your time. If we can be of help, please don't hesitate to give us a call, 800-928-4001, or scan the QR code and do so electronically. Thanks, and have a great weekend.